We bought a property when the market was supposedly crashing, and we share the insane results. Hi, I'm Sam Powell.
I'm Joe Kraus, and we're the hosts of the Property Powers Australia podcast. And in this episode, we talk about why we bought this particular type of property, how much for the entry costs, the LVR, the location, and also the results that we got within just 9 months, unexpectedly.
Yeah, it's a really interesting conversation, and we also jump into why and where to invest in locations outside of the normal perception when everyone is in fear more about the economy just because of what they're hearing in the media at the time.
Yeah, we also discuss the pros and cons of defence, housing, leases, and why people shy away from them versus what we actually did in this deal.
Yeah, then we jump into the healthy debate of cash flow versus capital growth. And we have a good little discussion around it, which was very informative. So listen on in. But before we jump into this episode, I just want to share with you that this is not the only way that we can help people for free. We have this really great resource on our website, propertypowers.au/resources, and it's a mini course on how to maximize your borrowing capacity to help you get into a better quality asset and achieve a higher ROI. See you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. All right, so I'm keen to chat about this one because this property, where do I even start with this? I guess I want to share this, and I think we should share this example or this case study because a lot of people I'm speaking to are buying property around this similar price range at the moment, and you're working with people doing the same thing, and people are making considerations on, do I buy a home first, and do I buy an investment property first, and what's better and why. And I thought just sharing this case study would be a good example of what's possible. Because especially in the market, right? Like everyone's like, oh my God, like recession could be coming, interest rates been going up, especially through and interest rates did continue to go up after I bought this property as well. Most people are thinking, oh, it's a worse time to buy.
When was it? Was it February?
Yeah, so we started looking in the end of maybe we secured it. We secured it before Christmas, remember? And at Christmas, I remember I was away. I was away with my family for Christmas, and we were on the phone, and that's another story to talk about. But we were on the phone, and I remember we confirmed, we signed a contract before Christmas, and then we had to wait for settlement a little bit longer.
Yeah. Was it a delayed settlement?
It was a delayed settlement, which was great. So that was December 2022, and then we settled on it in 2023. So do you want to share the details of the property and the purchase and stuff, or what have you got?
So Jared obviously was ready for his number 2 investment property, and had one in Western Australia. From a strategic perspective, I was looking to other markets just to round out the portfolio, and Southeast Queensland was really showing some good signs of growth at the time, with all the data that I was looking at and research I was doing into markets, and we got the confidence to go into Ipswich, which is obviously just, I think it's like 30k out of Brisbane.
Yeah.
So the ripple effect there was strong. There was some good infrastructure projects going through, which gave me a lot of confidence that the growth in that region was going to keep pushing forward. And obviously the house prices down there were, I think back then it was maybe it was under $500,000, the median house price, or just around that 500 figure. It was a really interesting market to buy into, and we were looking around, just sort of getting laser focused into what are the key areas we want to focus buying in, and the asset type was just a single house. So we're going for more capital growth than cash flow in this perspective. And there's everyone's like, oh, they want the best of both worlds, and it really was, because it was really strong capital growth prospects with a reasonably good level of cash flow. I think. What ended up renting for when?
We had it. It was renting at $420 a week. And then it was due for a rent increase because it was a DHA lease, right? And every year at the same time of the year, they do a rental review, and then they typically increase it if it warrants it. And so we bought it when it was getting $420 rent a week, and we had an estimate of what it could get, up to $440 to $460, and that was your estimate, by the way. And we, as soon as, we had the contract for sale, and then it changed after I'd signed the contract for sale a couple of weeks later, before even settlement, changed to $450 a week rent. So it went up $30 a week in rent, which was another good reason that we're purchasing the deal. I'm thinking I think about this more and more and more. There's so many reasons why we bought the property, and one of the bigger reasons was that, yes, it's a DHA lease, and it was ending in a couple of years after a 12-year stint, and there was the capital growth potential from a mini, very small renovation, because it's a 3-bedroom, 2-bath, and there was a front room, which is basically a bedroom. All it needed was a door hung on that wall there for it to become a bedroom. So that's what we were looking to reap in 2-3 years' time when the DHA lease finished. That would boost the value of the property. But thinking about it now, we didn't realize how well this property would perform. I guess, and that's what you do good, is you are under-promising and over-delivering.
Yeah, I'm not a good salesperson.
Which is great. I mean,
but you don't.
We're mates, and you're just straight up. So.
Well, yeah, but it's my own detriment, I guess. But also, you don't know what the future holds. It's a sound.
Exactly.
It's all the principles. I mean, there's always complexities, and the DHA which is defence housing for those listening, and there's complexities around the lease itself because. There's so many angles we can go this.
Let's go down them all because we've got time.
So, the play was buy a low-set house. I mean, going back to my point before, this was a $455,000 purchase that was renting once it was settled at $450 a week. So, right in that sweet spot around that 5.2% gross yield, which is really, really strong. If you go around Australia now, it's actually quite difficult to find something like that.
Well, even then, in the end of December last year, people were really struggling.
Yeah, and this is the beauty about these deals that come up was and it's a strategy I actually like more and more now, which is the DHA defence housing. They have leases over it, so they rent the property out to defence members, and by doing that, they charge quite a significant management fee, which is 15.5% plus GST.
Yeah, so then it'll be about
16.5,
yeah,
gross, and that's a lot higher than what most managers would charge, which is around that 7.5%, 8% range in Ipswich.
Yeah.
I'm going to sneeze in a second.
Yeah, that's fine. I think I'm at 8.8% in WA. But they're a really good property manager. And we've talked about property managers, why it's worth paying a little bit more than, trying to nickel and diamond for a 5% thing.
Well, it depends what you get. So some people do gross, like a full encompassing lease. That's what DHA do. They take into account everything in that fee. So the figure is high, but if you break down what they actually give back
for the investor,
it's really quite good. I mean, you don't deal with any maintenance issues unless they're large, and then they're probably more insurance based. But They look after the property.
They cover all the maintenance, and then they also recarpet and repaint.
Yeah, that's the
they
end
leave.
part. And that's like the kicker in. Like, I don't mind DHA leases, but only if there's a few years left in the lease, because from a growth perspective, it does hamstring it, and that's why we were able to get this property at such a great price as well. Was you can't advertise the address of the property on realestate.com because it's defence housing. It's like that's the clauses they have in the contract. So it really restricts the eyeball. So people scroll through, they see a property, they might like it, but it says, address available on request. And they kind of skim through it because they're like, oh, it probably doesn't even exist, or it's in a shit location. And this property, we were negotiating on a different one with a sales agent, and that's why we're constantly coaching people to stay top of mind with real estate agents in their area. Is they bought us this asset that I couldn't see on realestate.com, and I looked further into it. Once I found the address and got the details, initially it was like, oh, proceed with caution, DHA lease. Then delving further into it, realising there's only a few years left in it, but because it was held for over 9 years in the DHA lease, that they, on exit, they're required to do an internal paint, replace the carpets and the flooring, even do an external clean and do the landscaping. So basically hand you over like freshly renovated property at the end.
They also pay the rates, Sam.
No, they don't.
Well, they have paid mine.
Really?
Yeah.
Really?
I thought maybe they did, maybe they didn't.
Is it the water rates though? Or
no, it was council rates. And I sent it into their accounts, and they said, yep, confirmed, I've got the bill and we've paid it.
Yeah,
it's payable.
They'd pay it, but does your weekly or your monthly income reflect those rate reductions? Just check that.
I'll have to check that, yeah.
Because that's part of the service too. They pay your bills.
Okay, yeah.
And in their 16.5% is you just give them everything and they just go and pay it for you. So you actually don't do anything.
Yeah, well, that's right. This one I don't. They don't. It's not like my other property where they're like, yeah, we've got this thing happening. Do you want us to send a contractor out, or these are the two contractors? Which one would you like to choose? And based on the price, it's just like I don't hear anything at all
because
they just sort it and pay for it.
Yeah, and that's why they charge a higher fee, and that's why you actually get a really a lot of value out of it. If you're looking for more of a set and forget type play, the key was obviously set and forget for a few years, ride out that DHA lease. The risk is you don't want to have to sell the property in those 2 years, because by having the DHA lease over it, you're fully just removing all the owner-occupiers out of that market because they can't move into it for 2 years. So I saw this opportunity as, and especially the agent as well wasn't too educated on the market and what this thing was actually worth. And when it was brought to us, I had to stop myself from biting his hand off from that point of view. I still negotiated a little bit lower, but
you definitely. That's where I won in the conversation for sure. Is because you had that negotiation skill, trained by like one of the best negotiators in Australia. So
yeah, he's a weapon. He needs to get more into coaching and mentoring.
Well, you need to get him on the podcast.
Yeah. I've floated the idea, so hopefully he's listening, Scott.
Yeah, get on here, Scott. Chat to you.
But yeah, going back to that there's obviously a multitude of effects going through. I like the play of it's a 3-bed 2-bath double lock-up built in 2011 that you basically could buy, for nearly replacement cost in a really good growth location, and it had the ability with that front room, if you convert it to a 4th bedroom, increase your rents, increase the value because the valuers are comparing it to a 4-bed 2-bath. You've still got 2 additional living areas at the back. It was like this perfect little deal.
So hidden though, like not many people knew the little loopholes and what to look for and ask. So yeah, it ended up being a really good deal.
Yeah, and some people they don't like the DHA leases, but once you actually scratch the surface and understand what is involved, it's actually not too bad. It's not for everybody, but and they're really hard to find. And also, a lot of the sales agents that sell DHA, there's actually like a specific company that really specialises in it, and they know the true value, and it's hard to get good deals. But that's the benefit of being in the market all the time, is there's some good ones, and then there's some very great ones. Poor words there.
Exceptional ones.
But yeah, this is a win, and I mean the rental component, you always have to wait every 12 months. But then you as the owner too, you don't have to have negotiations with the tenant because they just put their own rent up.
Yeah, well, the DHA decides what the rent is, basically. Even though they're the ones paying the rent, they still keep it at current market. I think they get a couple of different reviews from a different outside.
We have valuer
outside valuers, and they do that at the same time every single year. It just gets put up, and so that'll get put up actually, at the end of this year. I want to share, like you've probably seen in the title, guys, some of the a part of the cool results in the case study and stuff like that. But there's more to share to that. Before we get to that, I want to talk about how I purchased it, and then break down some of the costs, what it cost me. But how I purchased is I decided to purchase. So the first property I bought in my trust, and then a second one I bought, this one here, I bought in my personal name. What I did is before I bought this, I went and refinanced my property in my trust to help me to use that as leverage with the banks to show them that it's profitable, to allow my borrowing capacity to be more superior. So that's one thing that I did first. And then secondly,
did you pull equity out?
No, I did not pull equity out. I just refinanced it and decreased my LVR, which is really good.
Yep.
So it helped me with borrowing capacity for buying again. Also knew that the interest rate environment was just disgusting for trying to get something that's positive cash flow at this time. And so what I did is I decided to buy it in my personal name, knowing that for the year or 2 or 3 or whatever it is where I'm basically negatively geared, I can use that as, against my taxable income, my personal taxable income.
Mm-hmm.
So it was it's a win for me for my, taxes, personal taxes, basically. Obviously it's not the type of investment that I would want to go for and endorse people to go away and buy negatively geared properties. But it was something that I could cop on the chin with how the interest rate environment was, to get me through a couple of years of, at least still being able to buy property.
I'd endorse negative geared properties.
Oh, you would? Why?
Well, it depends on where you're buying.
For that reason? This is actually, now I know why. Because of the property, the insane capital.
Yeah, growth.
It came with the growth for it. Yeah, okay. So we'll share that shortly.
There's always a trade-off.
Yeah.
You try to balance the best.
Which is really good because I'm close to being, neutral on this. It's still negatively geared, not by much. I forget, it's, maybe it's $120 a week or something like that. Or, no, I think it's about $100 a week, right?
Well, it's a pretty new property too, so you get depreciation as well. So you should get your quantity surveyor out there, get a report done, and then in the tax year, you break it all down.
Depreciation schedule, right?
Yeah, but even on a 5.2% gross yield, it should be pretty neutral. Once you take account if it's interest only loan repayments.
Yeah, it is interest only loan. So let's go through the cost. It was $455,000. I think I put a deposit down on 60 something thousand, and all up purchasing costs were about 80,000 with everything included.
Yeah, deposit, stamp duty, legals, and obviously the buyer's agent fee that you had to pay.
Yeah, exactly.
Well, I would do it for free, but
yeah,
at this time is.
I was not going to let you do it for free.
No. Well, that's what I've learned later in life is that your time is important.
Absolutely.
And, if you're going to do a good job, then you need to sort of go down that path.
And when you see the results, that you get people, you can't not charge the work that you put in. It's worth it. So
yeah, a lot of hours, a lot of time, but it's if you do it every day, you get really good at it, and then it gets to a point where it doesn't feel like work, and then when people start paying you for what you do, it's quite rewarding. It's an interesting journey to go down. That's for sure.
Yeah. When you see the results people are getting, it's just like, wow.
Yeah, well, that's the other thing
changed their
too.
lives.
It's like, well, this is why I love what I do. Is that property's gone from 455,000 purchase price. I mean, we did the calcs on another episode, but it's gone up around 25% in 10 months, based on what I had a look at. 9 months, based on what I had a look at the other day. So that's, I think it was $95,000 just in capital growth. And you sit there and go, yeah, that's phenomenal. And during a time where, as well, the last 12 months where you actually saw Sydney and Melbourne house prices decreasing, and even in parts in Brisbane were decreasing. I'm excited to see where the next few years go with this one, because it was that long term, 10 plus.
Yeah, we did not expect to see this. We did not expect to see the growth this fast. But I guess how this came about, Sam, is before I went to my last trip to Bali, I decided to get a rate review, and they were going to send out an independent valuer. I'd organised with a valuer to go out, and like the day that I was leaving, he was supposed to go out and do it. He didn't end up doing it, and we couldn't get in contact when I was away. Came back, and I emailed him and said, "What's the go? Like, how come we haven't got this thing sorted?" He said the bank decided to pull it and not do the valuation. So I called up the bank this week, and I went, "Hang on, like, let's get a valuation done on this property, because I want to decrease my interest rate." Right, my interest rate is 7.3%, which is like awesome.
That's high.
Yeah, it was quite high. And so I called him up and was like, "What's the go?" And I ended up speaking to the same guy, funnily enough, so weird, Bankwest. And he's like, "Oh, I remember, you're in the Navy." I was like, "Nah, but the property's DHA." And he said, "Oh, I don't know why we pulled the valuer doing a valuation, but I could look at it on the desktop and sort of see like where it's at. And I reckon," he said, "What do you think it's worth?" And I said, "Oh, it's around like up like mid 500s." And he's like, "Oh yeah, I think you told me like the last time we spoke we were worth like 550." And I was like, "Yeah, around there." And I was just like hoping, yeah, let's see what you can come back with. And he said, "Oh, on the computer it basically looks like I can get it approved for a valuation of 550. I'll put that in now and just confirm that later." But he said he's very, very confident in getting that. So then that helped me to decrease my interest rate. My interest rate down from 7.3 to 6.5%, which on a $400 something $1,000 loan, $6,000 loan or something, my interest payments have decreased $3,200 a year in interest. So I'm saving $3,000 a year, just over $3,000 a year. But the real kicker is $95,000 in capital growth in 9 months, which is massive. And I did not expect that. It was just like, I got the phone, I was like, fuck. And I just told you straight away, I was like, how good's this?
That's why it's addictive. And obviously the last few years have been really great, and why I'm still positive on growth in the Australian property market. It's going to get harder and harder with choosing select markets, but the short term is looking quite promising. And I guess the key is to just focus on the location you're buying in and then the asset you're buying.
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much in net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk?
Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do the same. Right now, for a limited time, we are offering free property coaching to our listeners. We won't be able to do this forever, of course, so head to propertypals.au/coaching. That's propertypals.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too.
Going back to what you're saying, with banks too, you can call up and negotiate your interest rate, but a lot of it is based around, if you can drop from an 80% loan to value ratio to a 70% loan to value ratio, it's a lower risk in the bank size, and therefore they can switch their interest rate to reflect that.
So I was at 90%.
Oh, true.
Yeah, and I got down to 73.
Yeah, nice.
Yeah.
That's sick.
Yeah.
Yeah, so even if you're 73, you can probably call up again in next year and just have a phone call, same
Yeah.
process,
Yeah.
and then they'll drop it, or speak to your broker, and they should be able to sort of twiddle things in the back end. Once you get under 70, it'll kick back down lower as well. But yeah, it's addictive, and it's cool to see the progression going through, because that is what's so key with maximizing your returns on your property portfolio is that like Australian average sits around 6.8% on a 30-year growth basis. So like think about that for a second. Like 6.8 is the average.
It's quite high still.
The last 12 months we saw 25%, which is really great. So that's really outperforming the market by 3x.
Oh, I thought you were talking about
4x.
interest rates, 6.8%,
4x.
not growth rates. Yeah, got ya.
Yeah, growth rates, but you're still you're at the whim of what's going to happen in the global economy, and there's going to be years where it does nothing. There's going to be years where it might pull back a little bit, but over the long term, the trend is your friend in this scenario.
Absolutely, and this is the thing. This is why it's so good to share this. Is because a lot of people were sitting on the sidelines in property because of all the news around interest rates and Sydney and Melbourne. But you talk about it's good to understand the global environment, and the whole macro environment, but also then Australia as a whole. The average is one thing to look at, and then you've got these other areas outside of those, Sydney and Melbourne, and you can find deals that are going there's different little economies within a larger economy in Australia, and if you can find those ones or hire the right people, wink wink nudge nudge, come and chat to us at propertypals.au. If you can find the right locations, then you just buy in the right locations even when everything else is doom and gloom. In fact, if I look at so many other markets, even if you look at the S&P 500 over in America, it's been growing. It's going up and up and up, and all other news stories are so different.
Yeah, I'd say there's 25% from a share perspective doesn't sound too good, but when you add in, you put 60 grand into that, so it's gone up $95,000 on your 60K invested cash. So then you're kind of looking at that return on investment. You're running at 150% return on investment in 9 months.
It's insane.
It's
cash on cash.
Cash on cash return.
Yeah.
Yeah. But then obviously if you sell it, you got agents fees and capital gains tax in the way.
Yeah, but you wouldn't sell it just like you wouldn't sell shares after 9 months if you were a proper investor.
Well, history tells you to hold because of the compounding effects of time. But if you're getting that kicker at the start, which is so key, right? Like a lot of people go around, they invest in their backyard, they don't get that first few years of kicker.
Yeah.
They end up it costs them money because
they're in their backyard, investing in their backyard.
Yeah, it doesn't have the growth prospects.
Yeah.
And then they've got the maintenance that comes onto it, and then it becomes a bit of a, I'm sick of holding this property, it's been 2 years and it's done nothing. And then that's when I probably come in there and buy it off you.
There you go. I love that. So that's where it beckons the question of what do you do next? Because and we'll talk about this on the next episode or one of the next episodes about all right, residential's been fun for me, and as business grows and cash increases, and then also these properties grow, you've got some equity there. I believe I'm not gonna sell either of the residentials, good, really foundational properties, but you can do some things with equity there rather than selling them and then taking if I was to sell it, then I'd probably I'd probably be able to sell it for more, but obviously I wouldn't be able to capitalize on the capital growth from changing that one bedroom to that one room to an actual bedroom, which would, if I was able to do that right now, yeah, it'd be a very different story, right? It'd be at $650. You saw a comparable sale, $650,000 in that area for a 4-bedroom, 2-bath versus my 3-2.
Yeah, once you drop that lease, you're in the 6s every day of the week. Basically, what I see. I mean, you got sales in the street in the 7s, so it's yeah, it's a ripper. So I'm super stoked. Everyone always talks about the good ones, but like
That's true.
there's also, I mean, I haven't really.
When have you bought a shit property?
Jeez.
I don't like.
Well, that's the whole reason of what I do. Like,
Yeah.
I look at I don't believe I've bought a shit property because
Mhm.
there's so many risk checks and
Yeah.
background checks, and also it's still time on the market, right? Like,
Yeah.
I was valuing through that GFC period at the start. I think I was during the valuation period. I was doing a lot of at the start when I was an assistant. I'm just thinking back now. We're doing a lot of like what do they call it? The past valuations. There's a specific word for it now. Just get my mind. Retrospective valuations, where we'd go back, we'd value the property as in 2009, 2010, based on what another value was put on it, and try to understand why they ticked off a certain property during this boom period, because people were like banks were hurting, so people would default on loans, and then they would. This is why valuers are generally a little bit more conservative, is because they are at risk of being sued. That's so. Your job as a valuer is to go in and to assess the market value of what someone's paid for a property, and then the bank lends the money on that. So when the GFC hit and property prices in certain areas plummeted and people were under financial stress and just sold it, the banks were going after valuers because they ticked off a contract price. But here's the difficult part: is you've got a house in a very boom market, which people probably would have experienced during 2021 when we saw that nationwide 25% growth, and they were just climbing over each other just to throw more money out to actually get the property because they wanted somewhere to live or to have that asset. So we were seeing prices just like, oh, I can't justify that on a comparable basis, but that was just the market that we were in, and the value would go in. Even myself, before I left the industry, I'd go in and ask the agent, like, this is a high contract price. What do you backup? Do you have any backup offers? And I'd actually get copies of backup contracts. So I'd put that in my evidence to justify. I'm ticking this off at $2.4 million because there's a backup contract at 2.38. There's multiple parties involved, and that de-risks it from my perspective. But the definition, you come back to any sort of court case, definition of market value is willing buyer, willing seller, local agent, arm's length transaction, where everyone, we mentioned this in another one.
Yeah, and those offers are contracts and arm's length, right? And that's the environment that you're in at that current time, and that's real raw evidence.
Yep. Yeah. So you try to de-risk it as much as you can, but they're not the markets you want to be buying into. You don't want to be there's a lot of hype around Western Australia at the moment, and days on market in some locations are 7 days, and
bring it on.
Yeah, good for you. You bought before that kicker, and that's what we're always in the market hunting. I'm scratching the surface to try and find locations that are going to be like that, but not yet.
Yeah, before it gets to that.
Yeah, and it's constantly changing. It's sort of every 6 to 12 weeks we're looking into
different areas.
Yeah, I get I work with some of Australia's best location research analysts and experts, and we spend a lot of time and money and effort doing that, right? And that's what's enabled us to outperform the markets, because we have mentors, have different.
It's a shame to see that people that are consumed by the news and do consume the news of certain areas, that they have so much, they've got only a certain amount of money, and they go invest based on what the news is saying, it's going up or going down, and these areas and whatnot, when they are not doing their money justice. They're not putting it into the best location. It's based on by the time it hits the news, it's old, right? Which is a shame, because if you understand that there's different small mini economies all throughout, like, you know, how one town might grow and thrive. It's maybe thriving because of some other small economy in Australia is lacking, right? And people move there, or, you know, because of a certain reason, or a certain thing will happen between trade or, you know, infrastructure and stuff like that. All these small little economies that people just don't know, or at least understand now that they're listening, to understand that these different small micro economies can grow and can shrink at different times based on the big narrative that the mainstream news is putting out there.
Yeah, you hear, like, throughout my journey, people would say a metric is to, when you hear something on the news, do the opposite.
Yeah.
And I didn't really understand at the time. Now I do. And there's always agendas behind media. They're there to create
Money.
It's marketing, right? Like it's actually crazy now once you start thinking about it. I mean, you even go and watch The Block. They're all drinking a coffee from McDonald's, and the branding's pointing at you.
Yeah,
and then every 2 minutes they cut to an ad break, and it's like the Ford Ranger. You know, it's just like far out. It's just constant. You're just getting bashed with it, and we're not even conscious to half the shit that's going on. But learning about sort of marketing, it used to be like 6 or 7 touch points would build trust, right?
Oh, it's like 23.
Yeah, I even heard 40 the other day.
Yeah.
And I'm like, far out. Like, and you can't understand why, because there's a lot of consumption going on. And, and also there's a massive distrust going on, I feel, underlying distrust in our economy. And rightfully so. I mean, my dad went to the post office the other day, and he paid for the post, like, you know, he's 74, cruises on, old Kez.
Legend.
Goes in there.
Legend.
He's like, I don't want to do this online. I don't get it. You know,
what a boss.
And the post office is literally like a 5-minute walk away. So he, hopefully he walked, maybe he drove. But anyway, he went there, he paid the postage, then he left, and then he said, by the time he got home, he got this text message saying, your payment for postage didn't go through. Click this link to update the payment.
Oh no.
Like, and he was like, he's like, what? And being Kez.
Well, it's so timely though.
But how is it? How's the accuracy on, like, he's geolocated? They know exactly what's, like, it's scary some of the stuff that people like.
So he got scammed?
No, because he's 74. He went back in the post office and was like, I've got to pay for this again. And they were literally just like, what do you mean? You've already paid for it. It's already gone through. And he's like, well, what's this? And they go, oh, wow, that's a scam. Oh. So I understand people just, like, even for us, we're a nationwide property agency. And then, I've dealt with clients, lovely humans, great people, but like I've never actually physically met them. And that can, if you get burnt, it can hold you back a lot. And but that's also restricting you from the quality of your advice too. Like,
absolutely,
you've got mentors over in America that I'm sure you've never met before.
Oh yeah, I've had business partners that I was business partners with for years, and still now, like I got business partners in Poland and stuff. So like, it's.
Yeah, you got to embrace it.
You do,
but with a healthy level.
And you tick all the boxes and do your due diligence and stuff like that. But yeah, I think it was just worth us getting on and sharing that. This is a bit of a case study that you guys can go away and break down and understand that, like, you can invest at any time and make money, and it's not just about positively gearing, as Sam said.
Well, it's a balanced portfolio because you had good cash flow and you trust, but then. Yeah, a lot of people, there's this big buzzword going around like, oh, I'm positively geared, and that's cool, but I just got to educate you on, well, you can go get positively geared properties. You're probably going to be in locations that aren't within close proximity to a major CBD. Yeah. And, the capital growth prospects are still there, but there's always a bit of a trade-off.
What do you weigh? Yeah, exactly. What do you weigh up? Like, do you want to earn an extra $100 a week, so $5,000 a year, or would you rather earn $90,000 or $95,000 a year? I mean, in 9 months, from capital growth. Like, what would you rather? Like, I'll take the $5,000 or the 95,000.
Yeah.
Like it's.
It depends on your strategy too. If you are requiring a heavy accumulation phase, you're going to need that cash flow to help support it. But then there's different ways where you've got a positively geared property. You've now got a slightly negative to neutral, which over 2 to 3 years will become positive anyway.
Yeah.
The main thing is you're not investing in a location that is on the outskirts of town with heaps of land supply.
Absolutely.
Like you can get those yielding properties that 7-8%, but they might also be in pockets of Rockhampton at the moment. You can get those higher yielding, but you're getting a fibro house with asbestos, and asbestos isn't bad. It's not the worst thing in the world, as long as it doesn't crack and break. But the age of the improvements are quite old, so you don't get any depreciation, and your maintenance costs might be slightly higher. So that initial cash flow you get on the Excel spreadsheet looks healthy, but you got to factor in. Well, I don't really know what the maintenance could be. It could be $0 a year. It could be $2,000. It could be $5,000. If you're cash flow positive for $100 a week, then there goes your $5K pretty quick.
It's funny to think that as well. Some people may have the perception that for borrowing capacity, they might be really fixated that I need to have something that's positively geared for my borrowing capacity so you can continue lending. However, if you are a little bit negatively geared like this one was and is, and you've got an extra growth from capital growth, that can increase your borrowing capacity and exceed it far more than $100 or so a week.
Well, flip that on the other side too. You now have an asset. Because your LVR is lower, your cash flow is actually has improved. So
exactly,
it's never one metric in anything in life. I find it's always you got to look at multiple aspects to make an educated decision. And it goes back to a classic comment, which is you don't know what you don't know, and you're not meant to. There's just so much information.
That's why we're here, guys. Listen to the podcast and reach out. hello@propertypals.au.
And another thing too, different strategies, right? Like next property we're looking at for yourself, we're going to look into what's the opportunity of a commercial play, because that's a higher income asset. There's pros and cons on that front as well, and we also had a mate that's recently bought a commercial asset. Well, he's under contract at the moment. So Dano, if you're listening to this one, we're coming for you to get you on the pod. I reckon it'll be a really interesting conversation, because he's just a lovely human that needs to work out a bit more, I reckon. maybe work on his golf.
I spoke to the other day. All he does is
play
golf and work out. He's coming to Japan actually with us for a ski trip. So I should get him on the pod before Japan actually.
Yeah, he's a good human.
Yeah.
But he needs to
share his knowledge
and his journey.
Because actually his story before that, in property, because I remember he came and chatted to me. He's like, "Oh, Jared, I'm going to buy a business. This is what can I do?" And I was like, "Yeah, let's think about business." And then I sort of steered him towards the property route. And what he has done with his 2 properties and the wealth that he had built to get into the commercial play, it's pretty cool. We should definitely get him and talk about the pre-work to get to commercial.
Yeah, and his strategy too was really interesting, because he worked in and he had to. Renting was a more beneficial option for him, because he got a lot of rent subsidies through his work, and it didn't make sense to go into a principal place of residence in that region. And then it was an investment play, and he was looking for strong cash flow returns and had quite a healthy deposit. So the commercial route, and he was appetite for that, him and his partner, and they went for it and they had a crack, and I think they've done really, really well. But their journey is something that people need to hear, in my opinion, because it wasn't smooth sailing. They've been looking around for over it'd be nearly 9 months.
Yeah.
And just the patience, and then helping them.
I started chatting to them almost a year ago, just under a year ago, about and then
Anyway,
all right, we'll wrap this one up. hello@propertypals.au. If you got questions, reach out. If you need some help, we're here for you guys.
Yeah, see you on the next one.